Nobody tells you the moment it starts happening. There's no letter in the mail, no notification on your phone, no conversation with a banker who sits you down and explains what is quietly unfolding beneath the surface of your financial life. It begins the day you open your savings account, proud, responsible, doing exactly what you were told to do, and it continues every single day afterward, with the same silent reliability as a clock ticking in a room you have forgotten to enter. The number in your account grows. You check it occasionally, feel a small wave of satisfaction, and move on. What you do not see, what nobody points to directly, is that, while the number is growing, something else is shrinking, not the balance. Something deeper than the balance. The actual power of that money, what it can do, what it can buy, what it is genuinely worth in the real world, is being hollowed out, slowly and continuously, by a process so embedded in the structure of modern life, that questioning it feels almost absurd. Almost, but not quite. And that almost is where this story begins. To understand what is happening to your savings, you first need to understand something that sounds almost too simple to matter. Money is not a thing. It is a relationship. It is a relationship between a number and the real world, between what your account says, and what that figure can actually claim from the economy around you. $100 is not inherently worth anything. It is worth whatever $100 can buy at this particular moment, in this particular economy. And that relationship between number and reality is not fixed. It is not stable. It shifts constantly, driven by forces that have nothing to do with your savings, habits, your discipline, or your intentions. The number stays the same. The relationship changes, and most people, watching the number and never watching the relationship, miss the most important thing that is happening to their money. Here is where we need to go somewhere that most financial conversations carefully avoid. Not because the information is dangerous, but because it is uncomfortable, and discomfort tends to drive people away. But sit with it for a moment, because this is the center of everything. Every economy in the modern world operates under the authority of a central bank, an institution with the power to do something that no individual, no company, and no ordinary government department can do: create money, not earn it. Not borrow it from somewhere that already has it. Create it from nothing, by a decision made in a meeting room by a small group of people whose names most of the public would not recognize. In the United States, this institution is called the Federal Reserve. In the Eurozone, the European Central Bank. In Japan, the Bank of Japan. The names differ. The power is the same, and that power, the power to expand the supply of money, is exercised regularly, for reasons that are rational within their own logic but whose consequences ripple outward into the lives of every person who earns, spends, or saves in that currency. When the supply of money expands, each existing unit of money represents a slightly smaller share of the total. This is not metaphor, it is arithmetic. If there are 1,000 tokens in a game, and each token entitles you to 1% of the prize, then doubling the tokens to 2,000 means each token is now worth 0.5%. The tokens still exist. The number on them has not changed, but what they represent has been done. This is precisely what happens to currency when the money supply grows faster than the real economy, faster than the actual production of goods and services that money is supposed to represent. The dollars in your savings account are the tokens. The expansion of the money supply is the doubling of the tokens, and the resulting reduction in what each dollar can buy is what we call inflation. Perhaps the most consequential and least examined feature of modern economic life. Inflation gets discussed constantly in the news, in political debates, in casual conversations between people who feel its effects without fully understanding its origins. It gets described as prices going up, which is accurate on the surface but misleading in a subtle and important way. Prices do not go up independently. Prices respond to the relationship between money and goods. When more money chases the same amount of goods, sellers, rationally, without malice, adjust their prices to reflect what the market will now support. The coffee shop owner is not greedier than they were last year. The landlord raising rent is not necessarily more exploitative. They are both responding to a monetary environment in which the purchasing power of the currency has shifted, and their prices are reflecting that shift. The cause is upstream. The rising prices are the downstream signal, and by the time you see them, by the time you feel them at the checkout line or the gas pump or the lease renewal, the cause is already weeks or months or years in the past. Already embedded in decisions made by institutions you have likely never thought much about. Now bring this back to your savings account. The interest rate your bank offers you on your savings is not random. It is not generous. It is, in most periods and in most countries, carefully calibrated to be competitive enough to attract deposits without being expensive, enough to actually protect the real value of what you store there. In environments where central banks hold their benchmark interest rates low, which they do during economic slowdowns, during crises, during periods of high government debt that would become catastrophically expensive to service at higher rates, commercial banks follow suit. The rate your savings account offers drops, sometimes dramatically. And if inflation is running at a rate higher than what your account is paying you, the math is unambiguous. You are losing purchasing power every single year, every single month, with the quiet inevitability of a tide going out. The number goes up, the value goes down. And the gap between those two realities is where your wealth quietly disappears. There's a concept that clarifies this with brutal simplicity, and it is called the real interest rate, not the interest rate you see advertised, not the percentage your bank shows you on the account dashboard. The real interest rate is that number minus inflation. If your savings account is paying you 1.5% annually and inflation is running at 3.5% annually, your real interest rate is negative 2%, which means every year you leave money in that account, you lose 2% of its purchasing power. Not the number goes up by 1.5%, which feels like growth. But the actual claim on real things that your money represents shrinks by 2%. You are richer on paper and poorer in reality. And this has happened not occasionally, not in exceptional circumstances, but routinely and predictably across decades and across countries. In every economy that manages its currency through a central bank with a mandate to keep inflation running at a low positive rate indefinitely. Why positive? This is a question worth sitting with, because the answer reveals something important about whose interests the system is designed to serve. Central banks in most major economies explicitly target a positive inflation rate, commonly around 2%, as a policy goal. They do not target zero inflation. They do not target price stability in the fullest sense. They target a world in which prices rise, continuously and predictably, by a small amount each year. The reasons given are technical. A little inflation lubricates the economy, encourages spending over hoarding, makes debt easier to manage over time. All of these things are true within their own framework. But notice what a persistent positive inflation rate also does to cash savings. It guarantees by design, as a feature of explicit policy, that holding money in a low-interest account will always mean losing something. The erosion of cash savings is not a side effect of the system. It is baked into the objective function of the people managing the system. The question is simply how fast it happens. The people who understand this, who have internalized it, not just intellectually, but in the way they actually structure their financial lives, do not keep significant wealth in savings accounts. They keep enough for liquidity, for emergencies, for the short-term needs that require immediate access to cash. But the rest, the portion they want to preserve and grow over time, they move into things that are priced in the same currency being inflated, assets, real estate, equity in businesses, things whose nominal price rises along with the money supply, because they are real, tangible, productive pieces of the economy that inflation flows through rather than erodes. When more money is created, asset prices rise, not because the assets themselves changed, but because it now takes more dollars to buy the same piece of reality. The person who owns the asset is protected by this dynamic. The person who owns the dollars is diminished by it, and this divide between those who understand which side of this equation to be on and those who do not is one of the quietest and most persistent sources of wealth inequality in the modern world. Someone in their 20s, starting out, putting money aside every month into a savings account because that is what responsible people do. They have been told by their parents, by school, by every bank advertisement they have ever seen that saving is good and that their bank will look after their savings. And so for years, they deposit, they accumulate, they resist the temptation to spend, and they watch the balance grow. Then one day maybe they want to buy a home, maybe they want to start a business. Maybe they simply sit down and calculate what their savings are actually worth in terms of what they could buy, and they feel a strange, disorienting confusion. The balance is higher than ever, but it does not feel like enough. The things they were saving toward have gotten more expensive. The gap they were trying to close has not closed. In some cases, it has widened, and they cannot quite identify why, because from where they are standing, they did everything right. They saved, they were patient, they trusted the process. What they were never told is that the process was not designed with them in mind. The most psychologically sophisticated part of all this is how invisible the erosion is designed to be. Not deliberately invisible, perhaps, but invisible by structural coincidence, by the fact that the number in your account does go up, that the interest does accumulate, that there is always some positive-sounding percentage attached to the account to make it feel like it is working for you. Human perception is deeply anchored to nominal values. We feel richer when the number is higher, and we feel poorer when the number is lower. And we rarely stop to ask what the number actually represents in terms of real purchasing power. Banks understand this. Their interface shows you your balance, your interest earned, your account growth, and these are all real numbers that genuinely increase. What they do not show you is an inflation-adjusted balance, a real return figure, a calculation of how many months of rent, or groceries or medical care your account could actually cover compared to 5 years ago. That information is available if you seek it, but it is not surfaced, not emphasized, not built into the experience of checking your savings. And so most people never feel the loss, even as it is happening. There is something deeper here too, something that goes beyond money and into the nature of how people think about safety. The savings account has become, in the popular imagination, synonymous with financial prudence, with being careful, with not gambling, with the admirable quality of delayed gratification. And this association is powerful enough to resist even significant evidence to the contrary. People who might otherwise question whether their savings account is actually serving them well find themselves unable to do so, because questioning the savings account feels like questioning the virtue of saving itself. These are different things. Saving, setting aside resources for future use rather than consuming everything immediately, is genuinely valuable. But where you save, and in what form, determines whether the act of saving translates into preserved wealth or gradually diminished wealth. Conflating these two questions, whether to save and where to save, is one of the most expensive mistakes a person can make over the course of a lifetime. Consider what happens when you tell someone, plainly and without judgment, that their savings account is making them poorer. The typical first reaction is resistance. It cannot be. The balance is growing. I can see it growing. And this reaction is completely understandable, because the nominal growth is real, the number does increase. The difficulty is in getting the mind to hold two true things simultaneously. The number is growing, and the value is shrinking. Our brains are not naturally built for this. We evolved to track concrete things, whether there is more food or less food, more water or less tea. The abstract relationship between a number and its purchasing power in a complex monetary economy is not something our instincts navigate with any particular skill. We have to think our way to it deliberately, which is perhaps why so few people do. It requires holding something abstract in mind for long enough to let it change your behavior. And the immediate emotional reassurance of seeing the number go up makes it very easy to stop thinking before the full picture comes into view. What central banks do with interest rates is also worth examining through this lens, because it reveals something about the relationship between monetary policy and ordinary savers that rarely gets discussed directly. When a central bank lowers its benchmark rate, it is essentially making money cheaper to borrow. It is reducing the cost of debt for banks, for corporations, for governments. This is done in the name of economic stimulation. Cheaper borrowing leads to more borrowing, which leads to more spending, which leads to more economic activity. In the short term, there is often some truth to this. But the other side of cheap money is expensive savings. When borrowing is cheap, lending is unrewarding, and savings accounts, which are essentially you lending your money to the bank, earn almost nothing. The same policy that makes it easier for a corporation to borrow $1 billion at a low rate simultaneously makes it harder for an individual saver to earn a meaningful return on their deposited funds. These are not separate policies producing separate outcomes. They are the same policy producing opposite outcomes for different people, and the people it works against are, systematically, those with the least, the workers, the savers, the people who followed the rules they were given and deposited their earnings into an institution they trusted to look after them. And here's what makes this particularly worth examining. The story does not require anyone to be villainous. Central bankers are not, for the most part, conspiring against the working population. They are managing enormously complex systems with the tools available to them, making trade-offs that are genuinely difficult, operating within frameworks inherited from their predecessors, and constrained by political realities they did not create. Banks are not running a scheme to impoverish their depositors. They are businesses operating within the incentive structure the regulatory environment has created, offering products people want to buy, and making a profit from the spread between what they pay depositors and what they charge borrowers. The system produces these outcomes, not because of malice, but because of design, because of the particular way incentives are structured, the particular way institutions are mandated to behave, the particular way ordinary people have been educated to understand their relationship with money. They change the design and you change the outcomes. But you can only advocate for changing a design you can first clearly see. What does it mean to clearly see it? It means recognizing that your savings account is a tool with a specific, limited purpose, maintaining liquid access to funds you might need in the near term, and that using it as a long-term wealth preservation vehicle is like using a garden hose to hold water indefinitely. It works for immediate use. It was not built to store anything. The money you park in a savings account for years, decades, the working lifetime of your adult life, that money needs somewhere else to go, not because gambling with it is wise, but because leaving it in an account whose returns are structurally set below the rate of inflation is the guaranteed loss that feels safe. While the alternatives feel risky, perception and reality, in this domain, are not the same thing. The question that naturally arises from this understanding is, if not the savings account, then where? And this is where the conversation becomes genuinely complex, genuinely individual, and genuinely dependent on circumstances that differ for every person. There is no universal answer, and anyone who offers you one is likely selling something. But the beginning of a real answer lies in the concept of real assets, things that represent ownership of something in the actual economy. A share of a company is a claim on the future earnings of a productive enterprise, a productive skill. All of these store value differently than a savings account, but they share one feature that the savings account does not. They tend to move with the economy rather than being left behind by it. This is not an argument for recklessness. Emergency funds matter. Liquidity matters. The ability to access cash quickly without selling something at a loss is a genuine form of financial resilience. The argument is for awareness, for the clear-eyed recognition that what you call your savings and what actually preserves your wealth over time may be two different categories, and that confusing them has real, measurable, long-term consequences. The gap between a 2% nominal return and a 4% inflation rate is small in any given year. Stretched over 30 years, compounded continuously, it becomes the difference between the retirement you planned for and the retirement you can actually afford. It becomes the difference between having options and not having them, between the freedom you worked toward and the constraint you did not see coming. Here's what all of this points toward. Underneath the economics and the policy and the institutional structure, money is a language. It is a way of communicating value, of storing the energy of your labor, of translating the work you did yesterday into the things you want to do tomorrow. And like any language, it can be spoken fluently or haltingly. The people who speak it fluently who understand the grammar of purchasing power, the syntax of real versus nominal returns, the vocabulary of monetary expansion and asset pricing, those people navigate this system in a fundamentally different way than those who learned only enough of the language to open a savings account and deposit their paycheck. Both groups may work equally hard. Both may be equally intelligent, equally disciplined, equally deserving of the security they are trying to build. But the outcomes diverge, not because of luck or talent, but because of understanding. Because of whether you can see the system clearly enough to position yourself within it deliberately. The savings account told you a story that felt complete. It said, here's a safe place for your money. Here's a number that grows. Here's your financial life, handled. But the story was missing its most important chapter, the chapter about what money actually is, where its value comes from, who gets to influence that value, and what happens to people who accept the first version of the story without asking for the rest. You have now heard more of the rest. Not all of it. The financial world is genuinely complex, and anyone who tells you they have simplified it fully has left something important out, but enough to feel the ground shift slightly beneath the comfortable certainty that putting money in a bank and watching the number grow is the same thing as building real financial security. It is not the same thing. It never was. And the moment you truly feel that distinction, not just understand it intellectually but feel it, and the way you think about where your money lives and what it is doing there, is the moment your relationship with your own financial life changes in a way that no interest rate, however generous, could have produced on its own. The number in your account is not the whole truth. Now you know what to ask next.